You're listening to BitTalk, a podcast about Bitcoin, money, freedom, and the ideas that matter. I'm Mike, and I'm here for the signal, not the spin. Lauren, we just got the latest data on Bitcoin's mining difficulty, and it's telling quite a story. A significant downward adjustment, the second biggest drop this year. It feels like a sigh of relief for miners, or maybe a warning signal. But what's it really telling us about the health of the network's backbone?
Hey Mike, welcome to BitTalk everyone. Let's jump in. You've nailed the feeling. That 7.76% drop in difficulty is like the network turning down the thermostat because the room got a little emptier. It's the protocol's brilliant automatic response to a dip in hash rate, and it reveals everything about miner economics, operational resilience, and why this system doesn't need a central manager to stay on track.
Exactly. So today we're dissecting this adjustment. We'll look at the numbers, the drop from 145 to 133 trillion in difficulty, the hash rate decline, what it costs to mine right now, and translate that into what it means for network security and the tough real-world decisions miners are making. No price talk, just the operational mechanics of sound money.
Perfect setup. Let's start with the core mechanism. For any new listeners, mining difficulty is the brain of Bitcoin's proof of work. Every 2 weeks, or 2016 blocks, the protocol performs a checkup. Did we average one block every 10 minutes? If blocks were found faster, meaning more computing power joined the race, it increases the difficulty of the cryptographic puzzle. If they were slower, it decreases it. This time, it dialed it down hard, from about 145 trillion to 133.8 trillion.
And the immediate cause for this drop, this dialing down?
Slower block times. We've been seeing averages creep over 12 minutes recently. That's the symptom. The cause is a decrease in the total network hash rate, the aggregate computational power securing the chain. It's down about 4% year to date, which might sound small, but it's actually the first Q1 drop we've seen since 2020.
So the network self-corrects. But what's the human and machine story behind that hash rate drop? It's not just numbers on a chart.
It's a pure margin story. Post-halving, the block reward is 3.125 BTC. If the dollar value of that reward, plus the tiny transaction fees, doesn't cover a miner's electricity and machine costs, they turn off. It's not a failure, it's a designed feature. The system sheds the least efficient operators to maintain equilibrium.
It's like a gym in January that's still packed by February. Only the truly committed are left on the treadmills.
More like a gym where the monthly fee just doubled, and anyone who wasn't serious about their fitness canceled their membership. The equipment, the network, is just as good, but now there's less waiting for the squat rack. The ones left are the most efficient.
I like that. Let's get into those margins then. The key metric for operators is hash price, the revenue per unit of hash rate. Where is it sitting right now?
It's at about $33.46 per petahash per day. That's down roughly 11% from 3 months ago. To put that in perspective, with electricity at a relatively cheap 4 cents per kilowatt hour, a modern, efficient 1 petahash machine might net about $25 a day. An older, less efficient machine? It's losing money from the moment you plug it in.
So the break-even line is incredibly sharp. What's the profile of a miner that stays profitable in this environment?
2 words: operational excellence. You need sub 4 cent per kilowatt hour power contracts, often tied to stranded energy or renewables. And you need the latest ASICs with efficiencies above 500 terahashes. If you're running anything below 100 terahash per second today, you're likely subsidizing the network out of pocket.
We're also seeing reports of public miners allocating capital to AI or high-performance computing. Is this a threat to Bitcoin's security, or is it just smart business?
It's smart business diversification, and it's a direct result of these economic pressures. Some mining facilities are ideal for GPU clusters. But here's the key insight. This doesn't hurt Bitcoin. The difficulty adjusts. If some hash leaves, it gets easier for those who remain. The security budget, the total value spent on proof of work, finds its level. It might even improve decentralization as low-cost private operators find a new edge.
That's a crucial point. The system is designed for this flux.
Exactly. I spoke with an operator last month who said his entire focus shifted overnight, from acquiring more ASICs to renegotiating his power purchase agreement. His job isn't just to run machines. It's to be the most efficient buyer of energy in his region. That's the job now.
Let's tackle a potential misperception head-on. Some might look at a falling hash rate and think the network is weakening. Is that a fair assessment?
It's a fundamental misreading. The security of Bitcoin isn't in a constantly rising hash rate line. It's in the cost to attack relative to the value being secured. Even at 133 trillion difficulty, the amount of real-world energy and capital required to disrupt the chain is astronomically high. The adjustment mechanism is the security. It ensures blocks keep coming, and the ledger persists no matter what.
And this streak we're in, 3 downward adjustments in a row, the first since mid-2022, what's that signal?
It signals the post-halving adjustment period is in full swing. The easy money from the previous epoch is gone. We're now in the phase where the protocol enforces discipline. It's separating operators with sustainable business models from those relying on perpetual bull market subsidies. It's the system working as intended.
There's a philosophical layer here too. This isn't just a technical mechanism. It reflects the ethos of sound money itself.
Absolutely. A central bank faces economic pressure. It prints. The network faces economic pressure. It adjusts difficulty. One devalues the currency to avoid short-term pain. The other maintains the currency's integrity by forcing participants to adapt to reality. Bitcoin mining isn't a handout. It's a competitive market for converting energy into final settlement assurance. This difficulty drop is that market working.
Let's crystallize this for our listeners, especially those running operations or thinking about it. What are the actionable takeaways from this adjustment?
First, know your break-even. Use hash price indexes and your exact power cost. Don't guess. Second, efficiency is non-negotiable, both in hardware and energy sourcing. Third, view difficulty adjustments as a planning tool. A drop like this is a 2-week window of slightly better margins, but the long-term trend demands constant optimization. For everyone else, watch these adjustments as the purest signal of Bitcoin's organic, market-driven health. No boardroom decisions, just code and physics.
So the thermostat did its job. The room's at a new equilibrium.
Until the next weather front, or in this case, the next wave of innovation in energy capture or chip design blows through. That's the cycle. It's not fragile, it's anti-fragile. It gets stronger from the stress.
Perfect. Lauren, thanks as always for sharpening the analysis. To our listeners, understanding these mechanics is understanding why Bitcoin stands apart. If you want to dive deeper into the data we discussed, we'll link to hash price indexes and difficulty charts in the show notes. Thanks for spending time with us on BitTalk. Until next time, keep learning, keep questioning, and keep stacking knowledge.